You need to see what just happened to silver, because what I'm about to show you doesn't happen often. In fact, the last time we saw a breakout like this, silver went on a run that changed lives, and if history is any guide, we might be standing at the beginning of something massive. Silver just broke out of a decade-long consolidation channel. 10 years. Think about that. For 10 years, silver has been trapped, coiling, building pressure like a spring wound tighter and tighter. And now that spring has finally released. The technical setup here is extraordinary. When you look at the monthly chart, you can see this massive ascending triangle that's been forming since the 2011 peak. Silver hit that high of $49, then spent over a decade consolidating, testing resistance again and again. Each time it got rejected, each time it fell back, until now. The breakout happened at the $30 level. That was the line in the sand. The ceiling that silver couldn't break through for years. And when it finally punched through, it didn't just edge past it. It exploded. We're now trading well above that resistance, and that former ceiling has become the new floor. Here's what makes this so significant. In technical analysis, the longer a consolidation pattern takes to form, the more powerful the breakout tends to be. It's like compressing a spring. The longer you compress it, the more explosive the release. Silver has been consolidating for over a decade. The energy built up behind this move is enormous, and we're already seeing the follow-through. Silver recently touched levels we haven't seen in years, pushing toward $35 and beyond. The momentum is undeniable. Volume is confirming the move. This isn't a fake breakout. This is the real thing. But here's what most people miss. The technical breakout is just the surface. What's really driving this move runs much deeper, because while everyone's been focused on gold, silver has been quietly setting up for something historic. Let me show you what's happening beneath the surface. The supply-demand dynamics in silver are unlike anything we've seen in modern markets. Silver is unique. It's both a monetary metal and an industrial metal. And that dual nature is creating a perfect storm. On the industrial side, demand is exploding. Solar panels require massive amounts of silver. Each panel uses about 20 grams, and global solar installations are accelerating at an unprecedented pace. Countries around the world are racing to meet climate goals, and solar is the primary vehicle. That means billions of ounces of silver demand that didn't exist a decade ago. Electric vehicles are another massive driver. EVs use significantly more silver than traditional cars. The electrical systems, the charging infrastructure, the battery management systems, all of it requires silver. And EV adoption is accelerating faster than anyone predicted. We're not talking about a gradual shift. We're talking about a fundamental transformation of the entire automotive industry happening in real time. Then there's 5G infrastructure. The build-out of 5G networks requires enormous amounts of silver. Every cell tower, every connection point, every piece of equipment. Silver is essential because of its superior conductivity. There's no substitute that performs as well. And the 5G rollout is global. It's happening everywhere, all at once. Add it all up, and industrial demand for silver is hitting record levels. But here's the problem. Supply isn't keeping up. Silver mine production has been essentially flat for years. There's no surge of new supply coming online. Mining companies aren't investing in new silver projects because the economics haven't justified it. Most silver comes as a byproduct of other mining operations. Copper mines, zinc mines, lead mines. Silver is often just a secondary product. So when those base metal operations slow down, silver supply contracts, and we're seeing that contraction now. Several major mining operations have faced disruptions. Labor issues, permitting delays, declining ore grades. The easy silver has already been mined. What's left is harder to extract, more expensive to process, and takes longer to bring to market. Meanwhile, above-ground inventories are being drawn down. The COMEX warehouses, which hold silver for futures contract delivery, have seen significant outflows. Registered silver, the portion available for immediate delivery, has dropped to levels that are raising eyebrows among market participants. When registered inventory gets too low, it creates the potential for a supply squeeze. The LBMA in London is seeing similar dynamics. Physical silver is moving out of the vaults. It's being purchased and taken into private hands. Once silver leaves these institutional vaults, it typically doesn't come back. It goes into solar panels, into electronics, into jewelry, into private storage. It's effectively removed from the available supply. This is creating a structural deficit. The market is consuming more silver than is being produced. That deficit has to be filled from somewhere. Right now, it's being filled by drawing down existing stockpiles. But those stockpiles aren't infinite. At some point, the math stops working, and that's when prices have to adjust, because the only way to balance a market in structural deficit is through price. Higher prices ration demand, higher prices incentivize recycling, higher prices bring marginal supply back online. But until prices rise enough to rebalance the market, the deficit continues. Now layer on top of this the monetary demand, because silver isn't just an industrial metal, it's also money. It's been money for thousands of years, and when people lose faith in paper currencies, they turn to silver. We're seeing that shift accelerate. Central banks around the world are trapped. They printed trillions during the pandemic. They kept interest rates at zero for over a decade. They inflated asset bubbles across every market. And now they're dealing with the consequences. Inflation isn't transitory. It's persistent. It's structural. And it's eroding purchasing power at a rate that's alarming anyone paying attention. Your dollars buy less. Your savings are worth less. The cost of living keeps climbing while wages struggle to keep pace. People are waking up to this reality, and they're looking for ways to protect their wealth. Gold is the obvious choice, and gold has been performing well. But silver offers something gold doesn't: affordability. You can buy silver in smaller increments. You can accumulate it gradually. It's accessible to a much broader range of people. That accessibility is driving retail demand to extraordinary levels. Coin dealers are reporting shortages. Premiums on physical silver coins and bars have spiked. When you go to buy silver eagles or maple leafs, you're paying significant premiums over the spot price. That premium is telling you something. It's telling you that physical demand is outstripping available supply. And here's where it gets interesting. The silver market has a unique structure. There's the paper market and the physical market. The paper market is where futures contracts trade on the COMEX. It's where banks and institutions hedge and speculate. It's a massive market, with trading volumes that dwarf the actual physical silver available. The physical market is where real metal changes hands. It's where industrial users buy silver for manufacturing. It's where investors take delivery of coins and bars. It's where the rubber meets the road. For years, these two markets have been somewhat disconnected. The paper price has been set by futures trading, while physical premiums have fluctuated based on actual supply and demand. But that disconnect is narrowing. Physical premiums are rising, signaling that the paper price isn't reflecting the true scarcity of physical metal. When that disconnect becomes too extreme, something has to give. Either physical premiums collapse, which would require a surge of supply that isn't coming, or the paper price has to rise to reflect physical reality. And that's what we're starting to see. The breakout we're witnessing isn't just a technical chart pattern. It's the market beginning to reprice silver based on fundamental reality. It's the recognition that silver is undervalued relative to its supply-demand dynamics. It's the beginning of a repricing that could run for years. Let me give you some historical context, because we've seen this movie before. In the late 1970s, silver was in a similar setup. Industrial demand was rising, monetary concerns were escalating, inflation was raging, and silver broke out of a multi-year consolidation. What happened next was extraordinary. Silver went from around $6 in 1978 to $50 in 1980. That's more than an 8x move in less than 2 years. Now, I'm not predicting that exact scenario, but I am pointing out that when silver breaks out of long-term consolidation patterns during periods of monetary stress and supply constraints, the moves can be explosive. In 2008, we saw another example. Silver bottomed around $9 during the financial crisis. Then, as central banks launched unprecedented stimulus programs, silver began to climb. By 2011, it had reached $49. That's more than a 5x move in less than 3 years. Both of those moves started with technical breakouts from consolidation patterns. Both occurred during periods of monetary uncertainty. Both were driven by a combination of industrial demand and investment demand, and both delivered life-changing returns to those who positioned early. Now, here's something most people don't consider: the gold-to-silver ratio. This ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has averaged around 60 to 1. Sometimes it goes lower, sometimes higher, but it tends to revert to that mean over time. Recently, that ratio spiked to over 120 to 1. That means it took 120 ounces of silver to buy 1 ounce of gold. That's an extreme reading. It suggests that silver was dramatically undervalued relative to gold. And when ratios get that extreme, they tend to snap back violently. We're already seeing that snapback begin. The ratio has compressed significantly. but it's still elevated compared to historical norms. If it continues to compress toward the historical average, and gold continues to perform well, the math on silver becomes extraordinary. Let's say gold goes to $3,000. If the gold to silver ratio compresses to 60, that puts silver at $50. If gold goes to $3,500 and the ratio hits 50, silver would be at $70. These aren't wild predictions. They're just mathematical outcomes based on historical ratio relationships, and there's reason to believe the ratio could compress even further, because silver's industrial demand is growing faster than gold's. Silver's supply constraints are more severe than gold's, and silver's affordability makes it more accessible to retail investors during a monetary crisis. Now, if you're sitting on retirement accounts, this is where things get interesting, because most people don't realize you can hold physical precious metals in a retirement account. It's called a gold IRA, though it can hold silver too. You can roll over funds from a 401k or traditional IRA into a self-directed IRA that holds physical metal. No tax penalties if you do it right. I put together a free guide on how this works. It's in the description. Worth checking out if you've got $100,000 or more in retirement accounts and you're concerned about where this is all heading. Anyway, back to what's happening in the market right now, because the institutional players are starting to take notice. And when institutions move into silver, they move size. We're seeing increased interest from hedge funds. Managed money positions in silver futures have been building. These are sophisticated players with deep pockets. They're not buying silver because they like shiny objects. They're buying because they see the same setup we're discussing. They see the technical breakout, they see the supply-demand imbalance, they see the monetary backdrop, and they're positioning accordingly. ETF flows are another indicator. Silver ETFs allow investors to gain exposure to silver without taking physical delivery. When money flows into these ETFs, the fund has to buy physical silver to back the shares. We've seen significant inflows recently. That's real buying pressure hitting the physical market. Even some central banks are paying attention. While gold gets most of the central bank buying, there are reports of increased interest in silver as well. Central banks understand monetary history. They know that silver has been money for millennia, and they're diversifying their reserves accordingly. This institutional interest is important because it adds a layer of sustained buying pressure that retail demand alone can't provide. Retail investors might buy a few hundred ounces. Institutions buy in tonnage. When they decide to allocate even a small percentage of their portfolios to silver, it moves markets. And here's the thing about institutional buying. It tends to be persistent. These aren't traders looking to flip for a quick profit. These are long-term allocators building positions. Once they're in, they tend to stay in. That creates a floor under prices and supports sustained uptrends. The geopolitical backdrop is also playing a role. We're living through a period of unprecedented monetary experimentation. Governments are running deficits that would have been unthinkable a generation ago. Central banks are buying government bonds to keep interest rates suppressed. The entire system is built on confidence in paper currencies. But that confidence is eroding. Countries are starting to question the dollar's role as the global reserve currency. The BRICS nations are exploring alternatives. Trade is increasingly being settled in currencies other than dollars. This is a slow-motion shift, but it's happening. When the global monetary system is in flux, hard assets become more valuable. Gold and silver are the ultimate hard assets. They can't be printed, they can't be debased. They have intrinsic value that transcends any particular government or currency system. Silver, in particular, offers a unique proposition. It's affordable enough for average people to accumulate. It's industrial enough to have real-world demand regardless of monetary concerns. And it's monetary enough to serve as a store of value when paper currencies falter. That combination is rare. And it's why silver has historically performed so well during periods of monetary stress and economic uncertainty. Now, let's talk about what could happen next, because the breakout we're seeing is just the beginning. If this follows historical patterns, we're in the early stages of a multi-year bull market. The first phase of a bull market is the breakout phase. That's where we are now. Prices break through resistance, momentum builds, and early adopters start positioning. This phase is characterized by skepticism. Most people don't believe the move is real. They think it's a temporary spike that will reverse. The second phase is the recognition phase. This is when the broader market starts to notice. Mainstream media begins covering the move. More investors pile in, prices accelerate. This phase is characterized by growing enthusiasm and FOMO. The third phase is the mania phase. This is when everyone wants in. Your neighbor is talking about silver. Financial advisors are recommending it. Prices go parabolic. This phase is characterized by euphoria and irrational exuberance. We're in phase 1. Most people still don't know this breakout happened. Most investors aren't positioned. The move hasn't made headlines yet. That's actually the best time to be buying, because by the time everyone knows about it, you're late. The risk reward here is compelling. Silver is still relatively cheap compared to its historical highs. It's still undervalued relative to gold. It's still underowned by institutional investors. And it's breaking out of a decade-long consolidation pattern with strong momentum. The downside is limited. Silver has strong support at the breakout level. If it pulls back, that's where buyers will step in. The upside, however, is substantial. If this follows historical patterns, we could see silver double or triple from current levels over the next few years. And here's the beautiful thing about silver. You don't need to be a sophisticated investor to participate. You can buy physical coins or bars from any reputable dealer. You can buy ETFs through your brokerage account. You can allocate a portion of your retirement funds through a self-directed IRA. The access is there. The question is whether you're paying attention, because opportunities like this don't come around often. A decade-long consolidation breaking out during a period of monetary stress and supply constraints. It's a setup that has historically produced extraordinary returns. But you have to act. You have to position before the crowd figures it out. Because once the recognition phase begins, prices will be significantly higher. Once the mania phase hits, you'll be buying at the top. Right now, we're in that quiet period where the smart money is accumulating, where the charts are screaming but the headlines are silent, where the fundamentals are aligned but the masses are distracted. This is the opportunity. Silver just broke out of a 10-year channel. The technical setup is historic. The fundamental backdrop is extraordinary. The supply-demand dynamics are unprecedented. And the monetary environment is creating a perfect storm for hard assets. The last time we saw a setup like this, silver went on a run that changed lives. This time could be even bigger, because the supply constraints are more severe, the industrial demand is more robust, the monetary concerns are more widespread, and the technical breakout is more significant. You're watching history unfold in real time. The question is whether you'll be positioned to benefit from it, because this train is leaving the station. And once it picks up speed, it's going to be hard to catch.